Hey, good morning, everyone. Marty Mazzora here, January 29th, 2022, with a quick macro update for you, and then I want to get to some technical work on stocks and precious metals and maybe even the dollar before we're done. The PWA macro index is in front of you there. This week we gave back what we gained last week. So last week we had a 4-point move. This week we had a 4-point decline, right back there at that 31.25 number. The data is mixed for sure, long ways from recessionary conditions in our view. And of course, as I keep repeating, though, I think we would have suffered something far, far worse last year, 2020. The setup was for something deep and protracted. And, a lot of interesting things can happen when you throw trillions of dollars onto an economy. And we're seeing that, of course, show up in many places. So anyway, we spent a lot of time on that. Of course, we will as we progress into midterm election year this year. Our consumer confidence measure, we actually look at three: Conference Board, University of Michigan, and Langer. University of Michigan's came back down to a 10-year low, folks. So yeah, consumers aren't feeling it right now. The weekly Langer index continues to roll over. And of course, the big problem among the consumers, according to surveys, is inflation. And we had the Fed meeting this last week. Chairman Powell did do what he was supposed to do, I think, and that is signal to markets that the balance sheet is going to stop growing with monthly purchases. Apparently, they're going to wind those up in March. I believe he did say that going forward, they're going to try to unwind the mortgage securities off the balance sheet and look for rate increases, I'm sure, a quarter point at a time. Fed funds futures are discounting almost 5 this year. That would be a tall order, I think, because I think the markets would resist that aggressively, and I think the Fed will have a problem with tanking markets. So they've really kind of boxed themselves into a corner, to put it mildly. And we have spent lots of time on that. Of course, we're going to have to as we go forward in terms of our commentary and our content on the blog. The Caterpillar global sales, I like to look at this. It's reported to us quarterly when Caterpillar reports their earnings. Coming down a bit. The overall 7% year-over-year increase versus 17 the last time. Actually, a second consecutive quarter decline in Asia growth, down 8%. Just a tiny 1% year-over-year growth for North America. Latin America, which we actually like going forward, 15%, so good growth, but off of the above 50% growth from the previous quarter. The only spot, and this is where they combine sales in Europe, Africa, and the Middle East, that saw growth up 24% year over year was there. So heavy equipment sales are mixed from a growth rate perspective, certainly waning. I like this one a lot. This is our leading economic indicator to coincident economic indicator ratio. Obviously, when it's going up, that says good things about the prospects for the economy going forward. As you can see, this has been a pretty good, long leading indicator. If this thing begins to roll over, you need to start thinking about recession, in the coming year or two. Did get what looks like a false signal here in the mid-90s, and then it really rolled over here in 1998. And then, of course, we had our 2001 recession, rolled over here in 2006 before the big 2008 recession and so forth. It was rolling over here before anybody knew about COVID, right? As were a lot of our indicators, which is why we started hedging portfolios in late summer 2019 while the Fed was saying, in fact, Fed Chair Powell said that this last week. He was basically saying the economy was great, it was sustainable, we were going to just continue to grow amid the longest expansion in the history of mankind. Unequivocally was not our macro assessment. We saw recession risk that exceeded expansion risk, and we weren't predicting when. In fact, in 2020, I saw the U.S. election coming, the Japanese Summer Olympics, and big celebrations among the Chinese Communist Party as incentives for their respective governments to juice their respective economies. But that wasn't our issue. Our issue was that recession risk was high, and if something hit it, we would have a doozy. Well, we had a doozy. It was the shortest recession on record. It was the deepest recession on record, but it was the shortest because of all that stimulus. It was the most precipitous 3-week decline in stocks far and away. It, more so even than the 1929 crash. But again, it's almost like the bear market and the recession that never happened, right? It's just you can barely see it, right, on the chart. So what does that mean? Does that mean that a lot of the excesses are still in the economy and in the market and so on? Well, COVID, certainly did a number on the economy for a short period of time. But folks, let me just repeat that households lost $11 trillion during this recession, and it took a good 4 years to recoup them. Households gained $31 trillion since COVID. And makes the job of an economist, a macro analyst, and in our view, especially a portfolio manager, quite interesting, to say the least, when we talk about controlling risk but finding opportunities to make money in a historically unusual setup, to put it mildly. The Chicago Fed National Activity Index, as you can see, this one's pretty noisy, up, down, down. This last month to negative 15. 47 of the 85 data points were negative, 38 were positive. The positives were most influenced by employment-related data. The negatives were most impacted by production-related data. PCE deflator, personal consumption expenditures, that's the Fed's favored inflation gauge, just came out for January. The highest rate of inflation in 40 years, folks. So something certainly to pay attention to. Now, we do see inflation cooling with bottlenecks easing and base effects and so on. But as you know, our long-term thesis is we're going to see structurally rising inflation at a rate faster than what we've come to experience over the last 40 years or so. The Bloomberg Commodity Index seems to be breaking out above this last September, October high, just barely. When you zero in on that chart, it looks like, oh my gosh, it's this huge parabolic move. But when you look back historically, right, we're still not to bull market peaks all the way back to the early 90s and since then. So our overall macro assessment said commodities probably have quite the ways to run, but my oh my, they don't run in a straight line. You can see we broke out of that substantially and came all the way back down and tested that line that has served as support and resistance in the past. But again, we want to own commodities right here. No ifs, ands, or buts about it. Okay, so folks, that's the wrap on the macro update. A lot of times I rattle off other global data as well, but we'll just stop it there. Right now, the Fed should be comfortable tightening monetary policy, and I think they will until the market gets very uncomfortable with it. And folks, we just kind of had a taste. We had a big bounce on Friday, and we'll look at that on the technicals. But up to Friday, the S&P was down just under 10%, but it recaptured 2+% on Friday. The Nasdaq was down a good 15 plus also, and it captured back about 3%. But we're still down, kind of almost in correction territory for the S&P on a year-to-date basis, and a little more than that on the Nasdaq. And we had some rebalancing, I think, that came in and took advantage of some of those lows. And we could see this thing just ramp right up and right back to new all-time highs. I'm absolutely open to all possibilities. But when we look at the technicals, you would say probabilities might suggest something else. And I showed you this flag pattern here in the S&P, and this has become quite classic. This is a textbook bearish flag. And I explained how the flag patterns are treated among technicians, and that is their consolidation patterns. So you get a big steep sell-off, and of course that's going to be consolidated. And where did it stop? Right here at this resistance that goes all the way back to June of last year, or I should say support. It was resistance, and then it became support, and then it held in July. It held here in September. It held big in October, and it held here. Intraday we went down below it, but it ended up holding. So that was a good spot for technicians to come in and buy. on that resistance and then consolidate these losses right here. And that shows up in a flag pattern. Now, if this flag works, what's going to happen is, or at least what technicians are going to target, is they're going to take the flagpole and they're going to go right here from the top, and they're going to create a new price target, right? And that price target would fall right there. And be interesting to see. Yeah, you can see it comes close to, right back in here, right? Comes close to areas of, an area right here that was resistance. And once resistance is broken, it tends to become support. So it's interesting always how these things kind of come together. Another thing that's coming together here is the S&P closed just a hair below the 200-day moving average, and that's been just substantial long-term support, and I mean really long-term support. So right now it's got maybe double resistance though. You've got the top of the flag pattern as a technical resistance potentially, and then you have the 200-day moving average as technical resistance. Now you blow through that, with some force, and I think you're going to ramp quickly right up to this line right here. And 45, 48, call it, on the S&P. And you can see it was strong resistance right here, and then it got busted. And it got busted with force, right? Just kind of what I'm explaining right here. So we came through that, tested it, succeeded, came up, created new resistance right here. The swing traders had a field day here for a while until it broke through with momentum, and then boom, right down to the next resistance. So folks, I think if it breaks through this with momentum, you could argue that there's some spots up in here, right, that, certainly I could do better than that. Certainly right about there, which would take you just below 4,200 on the S&P. You could get some resistance right in here as well. I mean, anything could happen. In fact, you can get anything. And it could be that we come right out of that flag, hit that right there hard, and come bouncing right out of it. Now, when we consider the longer term kind of indicators that we use, and these are familiar to you, and the momentum indicators, boy oh boy, we have just a classic negative divergence against all-time highs, classic bearish divergence against all-time highs. I mentioned the other day, this right here was an oversold condition that could absolutely lead to a bounce, and by how it did. And you do have a potential positive look here on the MACD to get another buy signal. This would have the green histogram here would have to move above this line, and that would be a crossover here as well. So but of course we got a rebound, so you're going to see some more constructive looks up in here as well. It's these longer term divergences that really need to be remedied before a technician who uses these indicators would say, okay, time to get bullish again. So let's put it this way: lots and lots of technical work to do here for the S&P 500. And when you go out a little longer term, right? Let's look at a weekly 5-year chart. So not a good look here. So we've broken down below this rising wedge, classic rising wedge pattern with momentum. This is the 50-week moving average. It just loads the same moving average for the time period I was using previously. If we wanted to match it to the 200-day, it would be the 40-week moving average, and that would be showing up right on top of that. Okay, so on the weekly chart, I'd say we could, if we continue to bounce, we're going to come up to about 45.12, and maybe find some resistance there, well above the 200-week moving average, which you can see was saved the market right back here in that 20% decline back in 2018. I say it saved it, just happened to stop right on that 200-week moving average as well. And you can even say the 50-week moving average has shown up as really good support. What you don't want to see is a weekly close below the trend line, and we've just seen that. And what you really don't want to see is a monthly close below the trend line. We do a 25-year monthly chart. And there is one more day in the month, so I guess anything could happen. But right now, we're looking at a monthly close below the trend line, and that is notably bearish on a longer term basis. The thing that is exceedingly bearish on the monthly chart would be as this crosses over and you get a MACD sell signal. When you look at these back here historically, it's really these big wide ones where we roll over with force where you get the big declines. This was about a 60% decline. This was about a 50% decline that coincided with that forceful sell signal, that white line crossing over the red. And we had all the divergences going into these longer term things on the monthly chart to be concerned about. Here we had just a minor sell signal, so it remedied itself pretty quickly. But we did get almost a 20% decline right there in 2011. Here we got it, in 2015 and 16 for a 16% hit in the market. Here we got it in 2018 for just about a 20% decline in the Q4 2018. And we started to get it right here, and then we came out of it, ironically, right before COVID hit, and then quickly, of course, that sell signal occurred. But we did have the bearish divergences big time, particularly here going into the COVID lockdown. And so, on the RSI, you've got that long, ugly divergence against a rising wedge. Don't have that divergence here on the MACD. What you have, except for the histogram, what you have, though, is a real threatening sell signal. And it may not occur. We may come out of that. You'll find periods in the past where it almost did and so on. But these charts suggest that probabilities lean toward more pain in this market in 2022. Wouldn't surprise me in the least. It's overdue. And that's just reality, folks. That's not me. I'm not bearish by design. I work very hard not to let any, my biases or my personality get in the way. In fact, if anything, I'm generally the eternal optimist. In fact, I am now in many ways, in many dimensions when it comes to portfolio management. And we were just, very, very bullish all this time up until, late August of 2019. Very bullish. We had quite the huge positive run because we had ample foreign exposure right back in here when foreign was outperforming the U.S. Our anticipation for the next bull market is something more along the lines of the one previously back in here. So I wanted to show you gold as well. Last time we looked at gold, I showed you this, what we call this buy zone in here on the 5-year chart, right? This green shaded area. Every time we got into the buy zone or hit the bottom of the buy zone, we came out of it pretty nicely. On the 1 year, we can just see that top green line. We had a really nice start to the year, and we have a a notable position in gold, but we quickly morphed into a rising wedge pattern. And on the RSI down here, we did have we did have our bearish divergence, and we here on the MACD as well. And we had a good sell signal right in here. This up in here is your classic island reversal pattern. You have these bars or these candles floating up above. You had a gap up, and then just kind of meandered there, and then a gap down, and it makes this island up above there. So you had this reversal pattern, the gap down. It played out pretty well, but where did we stop? Right at the top of this buy zone right here. The minute we started to enter that, traders jumped back into gold, right? And then here we have, that rising wedge. We had the Fed meeting, and that really played havoc. That's that big bar right there with gold, despite the fact that Chairman Powell pretty much said what everybody expected, and you might have thought would be discounted in the price. But I think the market's kind of in denial, with the Fed and what's going to be happening going forward. So gold is a long-term position. We do have it hedged with an option that's about right now 13% out of the money that we feel very comfortable with. So gold could just absolutely crater. Longer term, I've made this case since we got back into gold in late 2019. Previous to that, it was 1999. So you're not listening to a gold bug here by any stretch of the imagination. But we do think it's a pretty compelling argument, at least to have some in the portfolio right now. Silver, and by the way, I'm using our ETF positions to show you gold and silver. So SLV, our silver position. I like silver a lot. It's got that precious metal quality. It also has a huge industrial application, and it's huge in renewable energy applications, solar panels in particular. Rough go of it here of late. Can't seem to bust above that 200-day moving average. Really strong resistance. You can see it happened here again. The 50-day moving average rolling over, reflects this big drop as well. Not a good positive technical look for sure. What is positive is that it tends to find pretty strong support right in here at a little over 20 in terms of the ETF price. What we do have, though, is we do have a MACD and an RSI that are still showing quite positive divergences here. So it won't surprise me to see if silver does bounce over the next few weeks off of this level, days or weeks actually. If it doesn't and breaks down, then there's going to be there's could be more pain to the downside. This is a long-term position for us right here. Nothing about our long-term thesis has changed with regard to silver, so the price action isn't going to scare us out. But technically speaking, it looks pretty interesting right here. It looks almost compelling. The dollar is certainly playing havoc with the inflation trades, right? It's reflecting presumably the interest rates rising, or the expectation of rates rising in the U.S. It's also reflecting, global anxiety. We know we have the conflict with Russia going on right now. Dollars can be considered a safe haven at times like this. And I thought I'd show you the commitment of traders report for non-commercial futures positions in the dollar. So as you can see, that bullishness on the chart is being reflected in the net positioning among futures traders. And this is pretty big, right? So they are notably long, as we say. So if the dollar does start to turn negative, you could have some big unwinding of these positions, and that could exacerbate things to the downside. Last but not least, I wanted to touch on the NASDAQ. This is that ominous breadth chart that we started showing back in here, and sure enough, what has happened? The NASDAQ has had a correction, right? And again, that's why I showed this, folks. It has been pretty darn reliable. You can see we went further back, but here's a 12%, 9%, 7% as these divergences happening. 16% at the bottom here so far. What else do we have right here? We have just your classic, right? Pretty much flag pattern, although you're not consolidating, should be consolidating higher against the trend, but it still looks flaggy to me, if you will. And where did it stop? Right on this resistance line. You can see back here, right here where it found, I say resistance, I mean support, where it found support back here in February, March of last year, then again in May of last year, and then again now. If it breaks through that flag, remember, then we're going to have, a target, about the length of that flagpole, and that's going to take us right back here. Why did I draw that line right there? Well, move back here, and you can see that it coincides with what was resistance back here all the way back in October, November 2020, and then, you can call it support right there. But what was resistance becomes support, typically after your breakout. You see it here, right? Resistance and support, support, support. And so again, my drawing tool disappears when I turn it off, but this is about the length of that flagpole. When you come off of the top of the flag here, ironically, those two things come together. What you don't have with the NASDAQ is you do have this, this support line right here, which is a bit above where we are currently, and we could break through that flag easily, right? And then maybe have some resistance there. Long ways from the 200-day moving average on the NASDAQ. So I think if we had a big bounce here, my best guess would be that if we bounced out of this here, my guess would be that we could run into some resistance there, and then it'll be interesting to see, given that the prospects for 2022, if indeed we can bust back through that 200-day moving average. Apple earnings sure helped this a lot here this last week, and but we'll see. Time will tell. Lots to play out, folks. Longer than I anticipated as usual, but I'll leave it there. Stay tuned. Oh, one other thing. I mentioned in the written blog that I would be away for a few days. I'm going to end up being close to home. I unfortunately injured myself once again, this time again on the basketball court, and bruised some ribs. And that puts the kibosh on just a couple days of skiing that we were going to do. My wife actually has an ankle injury that she was nursing, so she wasn't going to ski anyway. So more information than you need to know. But so I'll be around doing the work as usual. And also, one other housekeeping thing. On that note, I like to show you at the end there before the quote, move for our overall core allocation using a proxy portfolio. we just looked at some regulation changes for our industry, or updates and so forth. And whenever you publicly say anything about returns for a firm like ours, they consider it advertising. And when you look through their criteria now, it prohibits pretty much what we're doing in terms of timeframes and benchmarks and so forth. How we show it in client reviews, it's perfectly compliant with everything, but me, quoting a percentage, even though it's like a half-hour move in the morning, doesn't fly with updated regulations. So I'll probably say something like, of our positions, this many are up, this many are down, and the top 5 up positions are this, bottom down positions are these, something like that. Because I think the subscribers probably find it interesting. We manage right now, as diversified a portfolio as we ever have. So I'll leave it there. Again, thank you for sticking with me, those of you who did, and hope you all have a wonderful weekend. Have a good one. Bye-bye.